Consumer spending to jump to not far short of 4% growth in 2018 compared to just over 1% growth last year. Some of the key factors that we think will help to drive the retail sector annual terms and should eventually propel also stronger consumer credit growth and rising consumer confidence, some of which of course is already happening. Perhaps I should say one of the great uncertainties about Brazil as we head through 2018 is the election, obviously, which is now, I guess, only 9 months away. Spending from annual contractions of 4% in 15 and 16, steady, a little bit of growth last year to much stronger growth in 2018, and of course that's exactly what is reflected also in the GDP numbers overall. We are expecting a nice rebound in CapEx as well, in investment. Although frankly it's going to be probably relatively slow given how much deeper the investment decline went. In other words, if you add all those 4 prior years of investment decline, you had a really sharp decline in CapEx. After a really truly terrible rise, signs of a turn in unemployment, which is going to go further according to our forecasts. And very helpful for the whole story in terms of policy flexibility, real wage growth, etc. Consumer credit Brazil, and he's Brazil-based, so this is not a bunch of gringos sitting in New York coming up with ideas on Brazil. It's actually coming from a Brazilian, obviously a very well-known Brazilian who's located, obviously, rate of investment up in the country. Because if you can get the rate of investment up, that will provide much stronger growth. And the way you get the level of investment up is we need to reduce the size of the public sector in the economy, because the public sector is crowding out the private sector, and this is a reason why Brazil has very high, has high interest rates in real and nominal terms relative to a lot of other emerging markets. And frankly, Chinese consumer spending GDP growth, which is a contrast not just with Brazil but with pretty much everybody, is basically 40%. If you almost flip that around, you don't literally flip it around because there's other things that go into the equation, but if you sort of flip it around, there's the investment share of GDP, which in Brazil is about 17%, and in China, again, China's an outlier, clear outlier, is about 45%. Now, if I was standing up here today telling you about China, what I would say to you is that what's happening in the Chinese economy is a rebalancing, we've used that term 1,000,000 times in the last few years, from high investment towards more consumer spending, from manufacturing, if you like, towards more services. And that reflects the fact that China came from a situation where they almost overinvested. They produced too much in the way of infrastructure spending, property investment, corporate investment, hence an investment rate of this sort. If we'd done this speech 5 years ago, this ratio for China would have been above 50%. Now, let's go back to Brazil. Why is the investment rate is low? It's because the savings rate is low. The investment rate is also low because real interest rates are high in Brazil, and real interest rates in turn are high because the government sector is big. And the fundamental long-term challenge that foreigners believe, and I wonder whether people will agree in the room here, that Brazil faces is to rebalance the economy away from the government sector towards more private investment, which would allow ultimately, of course, real interest rates to fall, and would be a general benefit for the overall private sector level. It's not a huge number, but just a few I want to illustrate for you. This is sovereign bond yields in Brazil, measured on the left-hand side, relative to MB plus, as we call it, which is the emerging market averages, many of you will know, and the gap between the two historically averages 600 basis points, which is pretty high. So what that's saying is that on average 10-year sovereign yields in Brazil average 600 basis points higher than the emerging market average. It's a great economy, it's got lots of natural resources, but I think until you end up with stronger economic growth, higher investment ratio, higher savings ratio, it is always going to be vulnerable to this inflow and outflow of money based on, as I've called it here, the carry trade side, only beaten recently by South Africa, which has, of course, an extremely volatile exchange rate as well. So uncertainty over global conditions, interest rates being high, coming down, the dollar being weaker, pushing money into Brazil, bringing money out of Brazil, leads to currency volatility. That's the black line, of course. This is measured in dollars, so we allow for the currency move you've seen. And it's been a very big outperformer of emerging markets. And that's what happens when things are going well. Brazil tends to be an outperformer. And the effect of that, and now I'm getting into my strategy jargon, if you'll just bear with me for a few. Forward PE, which of course you guys will all know very well from your being high, compared to where it normally is. So the way you read this chart is the black dashed line is the average relative PE for Brazil versus GMs, which is about -12, -13, so trades less than EM. At the moment it's trading broadly in line with EM, and therefore a little bit on the expensive side because lots of money has come into Brazil. In an environment where, frankly, earnings growth is good, but it's no better than EM overall, which is what this chart is showing you. And then another metric which we use, price-to-book ratio, is only trades to EM, and yet the rate of return on equity is quite low. And what people do, both fund managers and strategists, is tie up the rate of return on equity with the price to book. So you can argue in a number of ways that actually the Brazilian stock market has reflected some of the improvements in these global conditions, reasonably stable financial markets, a weaker dollar, interest rates staying low in the major markets and coming down in countries like Brazil. It's pushed the stock market up a lot, which is great, but it's meant that actually it's looking in some sense a little bit on the expensive side. It doesn't stop our forecast at UBS of consumer spending growth in real terms in 2018, and the red triangles are telling you what the long-term average over the last 7 years of consumer spending growth has been. You look at Brazil, consumer spending growth, as we said, just under 4%, well above its 7-year average. A number of other countries have got consumer spending well above their recent averages. India is a good example. Malaysia's not a good example. The Czech Republic, Central Europe is a good example, etc. There's a number of, Thailand is a good example as well. Now, the reason why we can maintain, in the face of a somewhat expensive stock market now in Brazil, a bullish view, and we think foreigners will remain constructive on Brazil, is that our view of global conditions in 2018 is favorable, i.e. the conditions that have propelled Brazilian asset prices forward in the last 2 years, we think broadly speaking are going to stay in place. And if I can just summarize, 8 to 6.4, and we think the US is going to pick up a little bit, partly because of the impact of the tax reform package, of course, that was passed by the Congress just before Christmas. Solid and stable this year compared to last year. You're going to see the dollar continue to drift lower in our view. You're going to see the cost of capital staying low. We do not expect there to be a big move higher in US bond yields. And although we expect the Fed to raise rates 3 times this year, my view at the moment, and it's been pretty clear over the last 2 years, is what's driving flows into emerging markets is not the Fed, but is what's happening at the long end of the curve, i.e. long-term US interest rates, which we don't think are going to go above 2.7% this year. By the end of the year, they're 2.55 today. The emerging markets as a whole are up about 5. The risk is obvious. Apart from your risks that you can mention to me in Brazil, like the growth doesn't come through or the election delivers a result the market does not consider to be friendly, the biggest risk we've got here is unquestionably US economy gets very strong, US inflation takes off, and interest rates and bond yields have to rise a lot. That will very quickly, I think, pull money out of the emerging markets, including Brazil. So the carry trade will go into reverse over the 2018 period as well. So expected economic growth. So where you see the bars, excuse me, above the triangles, it's telling you those are countries where the consumer spending to GDP ratio is beginning to rise. or is going to rise in 2018. China there, that's continuing the process that we said started a few years ago. You can see it's also true with Brazil, whereas a number of other countries where actually like Korea, like Taiwan, like Peru, like see a few others, Colombia, like the Philippines, where consumer spending is going to lag economic growth. Money to flow towards Brazil. What I would like to see, and it's a pompous thing for me to say as a transplanted Brit living in the US who covers emerging markets, but what we'd like to see is if you were to end up with a smaller government sector, a higher investment ratio, lower real interest rates, it would allow foreign investors to consider Brazil as much more of a fundamentally good story as opposed to a story where people are coming, in and out to a certain extent depending on what global financial market conditions are like, because as we know, there's a lot of great companies, great growth prospects in Brazil, including, of course, in the retail sector. Of Brazilian retail in 2018 stepping a little bit into the lion's den, given that that's what you guys do every day. We're expecting 9.2% retail sales growth this year, nominal 5.2% real. And the model that the guys run says that that's the sort of growth rate you should expect from a consumer spending growth rate in GDP terms of just below 4%, which, as you will recall from the beginning of the slide, beginning of the package, is what we're anticipating. Their argument is we expect furniture, home appliances, electronics within the consumer discretionary sector to outperform. The argument there is fairly mechanical. Those tend to be the sectors that are higher beta to an improving consumer story, or if you like, they are some of the sectors which react the most to an improving consumer spending story. And then if you look ahead to longer term opportunities and drivers, groceries because of the still low modern format penetration, apparel, drugstores, etc. And the guys have given me a very nice quick seminar on where the new labor law is coming in to benefit Brazilian retail in terms of improving the conditions under which people can hire short-term labor, temporary labor, etc., and to manipulate, to work on the hours that people are working. The new labor law clearly is a major positive. Now, as I rattled through, showed you earlier, so sometime around the second quarter of last year, you started to see this measure of household consumption going positive. What we've got here is we've got quarter-on-quarter seasonally adjusted data. We've also got year-on-year, but because perhaps primarily because inflation is coming down, and these critical ratios, debt to household debt ratios and debt servicing to income ratios are which are high, frankly, by global emerging market standards, but they are starting to peak and starting to come down. And frankly, we believe that the bottom one is the more important one, which is the debt service to income ratio. That's all those particular charts I wanted to show you. I'm going to finish off in my remaining 3 minutes I've got available to me just to show some of the metrics that we're looking at in terms of the Brazilian retail sector. So if you look here, you'll see that the black line is Brazil, MSCI Brazil again since the beginning of last year, which is when the market started to recover. You'll see the food retailers have done particularly well since then, up well over 100%. The non-food retailers a little bit less well over that whole period. And then we're just going to show you that what's happening in terms of the Brazilian retail sector is it's considered to be a defensive sector. It's considered to be what we call in our business a growth sector, not a value sector. Tends to trade at a higher multiple. And what you've seen unusually in 2017, and it's been a key part of my overall emerging market strategy, this is not just Brazil by any means. We've shown people that in a world where the dollar goes down, which is what happened last year, and markets go up, which is what happened last year, tip better than growth stocks. That wasn't the case last year. People were into growth, and of course it was primarily, to be fair, technology in Asia, but the effect of that is to push up some of these multiples which are looking quite rich in Brazil, both compared to other emerging market retailers, but also in particular to Brazil overall. There's the earnings growth numbers, which are, to be fair, a little higher. Price to book is also higher. ROEs are a little bit lower. So there's no doubt once again here that we are looking at a sector that is relatively fully priced. Investors like it, they park money there. It's a little bit more defensive than some of the higher beta, more volatile sectors in the Brazilian market. Now, if I can just sum up, very Brazilian story is something that investors globally really like a lot. They like it because of the quality of the companies. They like it because there's been a tremendous improvement over time in corporate governance. It is not in a world of where there's a lot of corruption, sadly, still across the emerging markets. It's not by any means one of the worst situations, far from it, in terms of conventional corruption, state capture, as people talk about it, which is impacting, for example, South Africa so badly at the moment. It's resource rich, it's population rich, of course it's got a young population as well. That would make it unquestionably a very stable long-term story for investors to believe in and to want to be involved in. And the only thing that's stopping it being more stable and less volatile is, unfortunately, the smaller size of capex in the economy and the overwhelming importance size of the government sector. Biggest goal for the government has to be, therefore, the biggest goal of the policymakers has to be reduce the size of the government sector, and as a result of that, bring the savings ratio up, bring the investment ratio up. That will create more stability, and that would allow Brazil to really fulfill its tremendous long-term potential. Thank you so much for listening so well. Thank you.